Hello and good evening. You're watching The Money Show. I'm Kavita Thapliyal, and this is a show that puts your money matters front and center in a world full of financial noise. We are here to bring you clarity, confidence, and control over your personal finances. Whether you're planning for retirement, building a portfolio, navigating debt, or just trying to make smarter money decisions, this is your space, your guide, and your weekly check in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trends, and answer your burning questions on saving, investing, spending, and everything in between. Because here on The Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice, and that is what we give you on the show. We also do your life financial planning. Just in case you want to send across your questions, you can do that on our WhatsApp number and our email ID that's flashing on the screen also. So let's dive right in and let's begin the show with our very special initiative. The beginning of the month often marks key financial activities, salaries, credits, bill payments, and planning expenses, etc. But just as we plan for our expenses, it's equally important to plan for our investments. To encourage this habit, SBI Mutual Fund, in collaboration with Times Network, has launched a nationwide investor awareness initiative, Bharat Nivesh, Behtar Nivesh, Behtar Kal. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. Now, as a part of this campaign, we are observing 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP or ensure your existing SIPs continue. So go and set your reminder to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. And today, we are talking about a very important topic: how to schedule STP for lump sum investment. We'll be diving deep into what do we actually mean by systematic transfer plan, and when we are talking about a lump sum investment, how can we effectively use this particular feature. I have with me Shilpa Gole, Principal Officer, Partner, NerdyBird Wealth Advisory LLP. Shilpa, hi, good evening and welcome to the show. So a lot of time we come across investors who wonder, that what is the right time to do a lump sum investment, or whether that kind of an approach is even good, or will they make more money by doing a lump sum investment, as compared to doing an SIP. So even if you have a lump sum amount, what advice usually experts give is that you don't have to put that money in one go. You can use something like a systematic transfer plan. Could you please break down the meaning of STP for our viewers?
Hi, Kavita, and thank you for having me on your show. So you're right. For lump sum investments, STP is a great feature that mutual funds offer for you to move in that money systematically, just like an SIP. So I want to take a moment and just talk about that word timing, right? So I think one of the things that a lot of folks want to do is take this lump sum. It might be a bonus that they received, as part of their salary, an annual bonus, a quarterly bonus. It could also be a large sum of money that has just accumulated in the savings account over time. There could be other folks who've received like an inheritance, a large gift sum. It could be something that they received through real estate sales proceeds. There are even people who have, moved their EPF money, redeemed that amount, and that lump sum is sitting in their savings account. And people look for these timing opportunities. They look for moments where, I will wait just a few days longer, wait till the market goes down just a little bit more, and then move my money in. The point is, even the best fund managers will tell you, Kavita, that timing the market is next to impossible. I think none of us can sort of predict where the market goes tomorrow. And therefore, timing is a big risk that you're taking, market timing risk. So, just like an SIP, which I think is your cousin of STP, even in an STP, this market timing risk goes away because you're moving the money in gradually, consistently over a few months, over a few weeks. You get to decide how frequently you want to move your money into an equity mutual fund. We're talking about equity specifically here. And now you're not worried about market timing anymore because your money is moving in little by little and it's buying into different points in the market cycle. So just like an SIP where you get the rupee cost averaging benefit, here as well you get that benefit where let's say you have 10,000 rupees that you want to move in gradually. Let's say that's your size of the initial STP installment, and that's the amount that you want to put in month on month. That 10,000 could buy you more units at some point, and it could buy you less units at another point, depending on where what the NAV of that mutual fund is at a certain point in time. So I think the best part about an STP is that it's taking away that risk of timing the market completely, Kavita. And now, if I had to just explain what it is vis-a-vis an SIP.
Sure. Yeah.
Yeah. So in an SIP, what's happening is that you have money sitting in your savings account, and it's getting auto debited month on month on a fixed date, a fixed amount, and it's moving into this equity mutual fund, for example. In an STP as well, your money is moving into a destination fund, but not from your savings account. It's moving in from a source mutual fund. So there is a source mutual fund where you can park this entire lump sum. The source mutual fund does not need to be linked with the market. It ideally should be this money sitting in a stable investment, not linked to the market. And from there, little by little, just like an SIP, you can set up an equal installment every month to move this money into a destination fund, Kavita.
But then I want to understand, how do you decide the amount? Because let's say if you have a lakh, okay, how many installments or tranches should you be opting for, and how do you decide the division?
Good question, Kavita. I think the decision of what that amount is totally depends. It's very relative, right? So 1 lakh may be a lot of money for you, given that you're sitting on a smaller asset base. 1 lakh may be a small amount for you. So if 1 lakh is a relatively small amount for you, you might be comfortable. Like you might be comfortable from a risk perspective to move that money at one shot into the market. Typically, I've seen that when people have, let's say, 5 to 6 lakhs onwards, upwards. So 5 to, let's say, around 10 lakhs or 20 lakhs, that's where they become comfortable with the idea of doing an STP over parking it in a lump sum. So I would say that it's very subjective, the amount that you want to do in an STP. Now, all the mutual fund houses have typically laid out a minimum of 6 months, 6 installments. So you can't do less than 6 installments, and those 6 installments onwards, you can then decide over how many months you want to move this in. So with my clients, I typically take like a 6 to 12-month period, depending on what the amount is, Kavita.
I also want to understand any specific time implications and also the vehicle where you should be doing an STP, because let's say an investor has multiple funds in their portfolio and they want to segregate amount across funds. Okay, how should you do an STP? Should you be having a liquid fund where you should put a money, but then that liquid fund should be from a fund house where you want to invest the money, that fund house's particular equity scheme? So how do you strategize it when it gets to implementation? How do you do it?
Great. So when it comes to implementation, let's say you have 12 lakhs to park into equity over a staggered period, and you want to set up an STP. So what you can do is this 12 lakhs, you can divide across 3 mutual funds, right? So, and these 3 mutual funds typically could be from 3 different fund houses, 3 different AMCs. So you could have the first, mutual fund, which is from, let's say, AMC A, then AMC B, and then AMC C. So let's say you got 12 lakhs, you parked 4 lakhs with A, 4 lakhs with B, 4 lakhs with C. This is an illustration. I would say the actual asset allocation will depend on the destination fund. So let's say your destination funds are one flexi cap, one, let's say, large cap fund, and one a small cap fund. So you may want more going into the large cap index fund. So you might decide that 50% of this 12 lakhs. So 6 lakhs goes into this destination fund, which is a large cap. Then you decide that, okay, another 3 lakhs goes into a flexi cap, and then the remaining amount goes into a small cap. So the moment that division is clear to you, you then split up your liquid funds accordingly. So you choose, so say, for example, just for an example, if you had to go with Parag Parikh flexi cap, for example. So you start with a Parag Parikh liquid fund and then gradually move this into Parag Parikh flexi cap, which is your equity destination. So similarly, you choose other liquid funds from different AMCs. These could be liquid funds, they could be low duration funds, short duration funds, anything that's holding your money in short-term debt instruments, Kavita, because these are not linked to the market. And the other important point is they don't carry an exit load. So most of them don't. So there are certain smaller schemes which do carry an exit load. So I would tell the investors to look very carefully at the terms and see when the exit load kicks in and if there is an exit load at all. Luckily, most of these liquid funds and overnight funds don't have an exit load, or they have a very negligible exit load. So that works really well because you can immediately start setting up that STP from your liquid fund to the equity fund, Kavita.
All right, I think that will be all for this particular segment. But thank you so much for breaking down STP and the implementation in a very practical way. Thank you so much, Shilpa, for being there for our viewers today.
Thank you.
Okay, so time for a quick break, and post that, let's talk about Fed rate cut and its impact on the fixed income exposure that you have in your portfolio, and also what impact would we be seeing on the Indian markets and strategies for your portfolio after this break.